All right, guys, let's quickly take a look at that upcoming Bank of Canada policy decision scheduled for 2:45 UK time, and 45 minutes after that, we also have the press conference. It's always important to understand that whatever potential trade we get into out of the rate decision and the statement itself, that trade is always going to be at risk as we go into the press conference, because there's always the risk that the decision itself and the statement sounds very dovish or comes across very dovish, and then the governor sounds more hawkish at the press conference, or the decision and the statement sounds hawkish and the governor potentially sounds more dovish. There's always going to be that risk. We don't know what they're going to be asked. We don't know how they're going to respond to those questions. So just keep that in mind, as always, as a potential two-way risk for any type of trade that we potentially get into out of the decision and the statement itself. Now, this meeting, it has the potential to create some juicy volatility, obviously depending on the outcome. But purely because of what the markets have already priced in, there's also the risk for this thing to be pretty messy. But I'll explain why in a second. Let's firstly start, as always, to see what exactly has markets priced in for this meeting today. If we quickly take a look at interest rate futures, we can see that futures currently imply about a 78% chance of a cut from the bank. Now, this has actually come down from Monday, where we were seeing about an 82% probability, but we're still fairly close to that 80% mark. And it's also interesting to note that the economist community also sees a very similar story, a very similar outcome, with 75%, or let's call it 76% of them polled, actually expecting the bank to follow through with a cut today as well. Now, it's also worth noting, as always, that from a positioning point of view, the markets have expressed a bearish view on the CAD for quite a while now, with positioning currently quite stretched on the short side coming into this meeting. Now, are there reasons for the markets to be leaning towards a cut today? Are there reasons for the markets to have held this bearish view on the CAD? Yes, the data does allow the bank the cover that they would need to cut rates today, and that has been one of the key drivers why the markets have been bearish on the Canadian dollar. But there is a couple of caveats with that data as we head into this policy decision. Firstly, let's start with inflation. That's obviously, one of the major focus points still for the market. So let me just quickly grab that on the screen here for us. Let's go to inflation for a second. And let's just quickly open that up. Here we go. So when it comes to inflation, we spoke about this on Monday as well. All three key inflation measures, that includes your headline inflation, your regular core inflation, and the bank's preferred measure of core inflation, which is that orange one, which is the average between CPI median, CPI trim, and CPI common. It's important to note that all three of these key measures are now within the bank's 1 to 3% tolerance band, right? So we are below 3% on all three of those measures. That alone does give the bank the cover that they need to potentially cut rates today. The counter argument that could be made against that, though, is that whether this drop just below 3% for that average of the three, that core measure, that bank's preferred measure, the real question is whether this drop just below 3%, going down to 2.7, of course, whether this has been enough progress for the bank to be confident to potentially cut rates today, instead of just giving it, another month. I mean, what is just another month until July, when they will have more data available? They will also be releasing their updated economic projections at the July meeting. So there is reasons for them to potentially just wait another month. It won't be this earth-shatteringly big surprise for them to say, yeah, we're below 3%, but let's just give it another month. So that is the counter argument to all three measures being below 3%. Yes, they are below 3%, but that doesn't guarantee the bank to be to cut rates. That's important to understand. Secondly, let's quickly consider the labor market. Let's just go there and let's open up the unemployment rate here. There's been a lot of focus on the unemployment rate recently, ticking up to 6.1%, which is the highest since 2021. And even though wage growth is still high, there is a view right now that as long as this trend remains tilted to the upside for the unemployment rate, that wages will eventually push lower. Now, again, there's a counter argument. The counter argument here is that at 6.1%, the unemployment rate isn't exactly at scary levels compared to the to history, right? Again, at 6.1%, this doesn't force the bank's hand today to cut rates because, wow, unemployment rate is at 6.1%. Yes, it is at 6.1%, but we are still at historically super low levels here. So that in itself for me isn't enough, conclusive reason for them to say, yes, we have to cut today. This could be taken as a reason to, again, just wait another month. Now, thirdly, let's consider growth. That's been the other key focus. Recent growth data, if we go to the data here, just want to show you guys that from the last print that we had. Let's do this. Let's just go there. If we take a look at growth, remember that growth, the GDP data we had last week, it missed the market's estimates by quite a bit, right? Expectations was for this to come in at 2.2%, up from the prior one. We came in at 1.7, which was below the market's minimum expectation. And more importantly, it was also well below the bank's own estimate for growth, which is 2.5%. So that means that you have inflation falling, right? You've got, if we go back there, we have inflation, all three measures below 3%. You have the unemployment rate ticking up to 2020 to the highest since 2021, and you have growth below what the bank thought that it would be. So all three of those things does give them cover to cut. Now, again, when it comes to growth, what's the counter argument here? If you take a look at growth, at 1.7%, growth is hardly falling off a cliff here. At 1.7%, it is still at the highest level since the first quarter of 2023, right? So we have seen improvement in growth over the last 3 quarters. So yes, it came in lower than expected for both markets and the BoC, but it's not a bad number. So with all of this in mind, it's clear to see why the majority would see a higher probability for a cut. But there's also enough reasons to explain why we are not seeing an overwhelming majority saying, yes, we think it's going to be a cut, because there is some reason, some counter arguments for the bank just to give it another month. There's no, I don't think there's as much need for them to do it necessarily today. Do I think they should be cutting rates? Look, I think they should, because the trend in inflation suggests that they can allow themselves a cut. But what is one more month when you're dealing with interest rates, right? I just don't think that waiting one more month will be that big of a deal for them. And I think that there is a risk that they decide to do that. The other thing that we need to consider here is that the BoC has not exactly been consistent with their communication in recent months. At times, they've sounded very sure that inflation will get down to target, and at other times they've sounded less sure. And I mean, they flip-flop almost from meeting to meeting. Now we're sure, now we're less sure. Now we're more sure, now we're less sure. So even though and sometimes those views from the bank has contradicted what the actual data has shown us. So the reason why that's important is that you can make a claim in any direction here, and the bank can make a claim in any direction as well. There's lots of arguments for a cut, but there's also some, in my opinion, valid counter arguments against the cut for today. Now, that's important to understand. It seems like the bank, if you look at their recent communication, they've basically been making it up as they go, which has seen quite a few times where they have surprised the markets, the market consensus at least, by quite a decent margin. Now, the other tricky part about today's decision is that whether they cut or hold, it can, of course, create some very short-term initial knee-jerk reactions, right? Where if they cut rates, let's just quickly go back to interest rates here. If they do decide to cut rates, that can see some initial CAD weakness, obviously because we don't have 100% probability of a cut. So that can still surprise some participants in the markets. But because we are 77 or 78% already priced towards a cut would see a smaller initial reaction compared to a surprise hold decision, right? That'll see a much bigger initial reaction because it'll basically cause the markets to price out that 19 basis points of cuts that's already priced in, if that makes sense. Having said that, whether they cut or whether they hold will only have a sustainable follow-through if the forward guidance that we get confirms that decision. So, for example, let's just suppose that we do get a rate cut. We could see that initial weakness in the CAD because we don't have a cut fully priced in, as we discussed. But if they don't sound confident that they'll cut again, right? If they sound like it's a cut and wait, then the CAD could weaken on the initial cut, but then rally a lot on the reduced cut expectations towards the end of the year. Because remember, there is 65 basis points worth of cuts already priced in. So if they do cut, that takes away 25 basis points of that, right? But if they then say, well, we're probably going to take our time now and see how the data develops, then that doesn't sound sure that they're going to cut again, and that could actually see the CAD rally. Vice versa, let's say they hold rates. We know that that will be the bigger initial reaction in the CAD, higher, because there is 77 or 78% chance of a cut already priced. But if they hold, but they clearly open the door to start cutting in July, and they sound dovish enough to suggest that they will cut at least a couple of times, then we could see the CAD reverse that initial upside of a hold as the markets discount that and trade flat, because the bank will just confirm what rate markets have already priced in until the end of the year. So that does make trading today's event tricky, because we can't just focus on the actual cut or hold. We also have to establish what the statement suggests about forward guidance, and whether that forward guidance is clear enough for us to trade. And then we also have to worry, of course, about the press conference, where we'll need to trust Governor Macklem to stick to a clear communication path in line with the rate decision and in line with the statement, which is a pretty tall order for the bank given their recent shenanigans. So all of this just means that we need to be really cautious with what type of outcome we want to see or trade for this event. Now, as always, let's quickly take a look at a few of those scenarios then. We've got four scenarios here that I think we need to focus on. We've got on the left-hand side, the cleanest dovish outcome. On the right, we have the clearest hawkish outcome. These two will obviously be the higher conviction, potential more sustainable trades that we can look for. More so on the hawkish side, purely because the markets are incredibly short this currency already, but both of them, can be tradable. The ones in the middle are the messy ones, and those are ones we need to trade very cautiously. That's why I said initial dovish with a risk of reversal, initial hawkish with a risk of reversal. These two, they could be tradable, and I'll explain how we could potentially trade them, but they are going to be far less far lower conviction trades compared to the far left and the far right. So let's start with a dovish decision. Let's just say we get that cut, which the markets are 78% price for. The best case scenario, if we get a cut, is that the forward guidance clearly states that the bank has confidence in the trajectory for inflation, and they clearly guide that it's likely they will need to do additional cuts in the months ahead. That'll be the clearest dovish outcome. They cut rates and they say, yes, we need to cut more in the months ahead. Now, the one risk with this view is that isn't that exactly what the market's already pricing in? Right? So could that see downside in the CAD? It could. And that would be the highest conviction, trade for the CAD lower. The risk is just looking at positioning. The risk for that type of view is that whatever trade we do get out of that will probably be a shorter term trade, because we don't want to run the risk that what they say just gives the rates markets what they've already priced in, and that sees a buy the rumor, sell the fact reaction. That is a clean risk that we need to be aware of going into that decision or going into that outcome. Now, if we do get a clean cut and we do get clear guidance that yes, more cuts will be coming in the months ahead, what can we look to potentially trade? Look, right now, there's only one currency that I'm really bullish on, and that's the Kiwi after the recent RBNZ policy decision. So Kiwi CAD longs does make sense. The risk here, once again, like we just discussed, is take a look at how far this thing has come already. We are trading at some seriously high levels here. We've had a one-sided move without any meaningful pullbacks. Do I really want to be chasing this thing at the highs? It looks very risky. Right, so that is one option, but it's a risky one at that because of positioning. The other one that we can look at is potential dollar CAD longs. Now, just hear me out. This will require us not to trade directly out of the decision, but to wait for the ISM data to play out. Because if we do get a clean cut, we do get clear guidance that yes, more cuts are coming after this one, then we could potentially look to get into dollar CAD longs if the ISM data 15 minutes after the decision. So let me just show you guys what I mean by that. We get the BoC, and then 15 minutes after that, we get the ISM. So if there is a clear cut, clear dovish statement, clear dovish guidance, and this data comes in super hot, then we could potentially look at something like dollar CAD longs. The risk is that if we do see that initial dovish reaction, by the time that we get into the ISM data, dollar CAD might be trading close to key resistance at that time. So you might be getting in at key resistance, which is never ideal, right? So you guys see what I mean, is that it's a messy one. It's a risky one at that. There's no rule to say that we can't break through these resistance levels and trade higher, but you've got so many that you need to navigate. You need to navigate 37.35, 37.44, 37.60, but above that we've got 37.84. There's so many levels that could offer key resistance. It's risky, right? So just keep that in mind. Now, what about the other one? What about the initial dovish with a risk of reversal? That is if we get that 25 basis point cut, but the bank explains that cuts won't happen at the same pace as the hiking cycle that they were in, or that they got into, and the bank will take their time. Sorry, that's take time, not take time to assess the need for more cuts patiently. So if they come out saying that today's cut doesn't mean that we're just going to start cutting rates like crazy, that could see an initial weakness on the cut and then a reversal of that move, and a pretty punchy one at that, right? So this one, like I said, yeah, it's too risky to trade initially, but if the ISM is a very strong beat, then dollar CAD upside on this outcome could be an option as well, but it's one that I'm going to stay out of. If we're not going to get a clear, clean-cut dovish reaction, and even that decision is a risk with, things like positioning in mind, what type of chance do we really have with a dovish outcome with a risk of a reversal? It feels very messy. It feels very risky. I won't have confidence holding on to that and saying, yeah, I think this thing is going to fly. It's risky. So in both of these two scenarios, it's probably best to wait for the ISM. The risk with waiting for the ISM is that if the initial reaction is very strong, you might have to buy that thing at some pretty high levels into key resistance, which I don't know, it doesn't feel worth it in a session like today. The other one, let's take a look at the initial hawkish with a risk of reversal. So let's just say they hold. That obviously will see that initial pop higher in the CAD, because the markets will need to price out that 19 basis points worth of cuts they've already priced in. That could see some tradable opportunities to the downside, to the upside for the CAD. The risk of reversal is that if the guidance states that the bank is confident in the path of inflation and they clearly guide towards cuts to likely start at the July meeting. So if they say that we are holding now just to cut later, is that really hawkish? Initially, yes, but from a guidance point of view, not really. There's a risk that that initial move higher could be reversed as the markets realize that, yeah, okay, fine, they're going to start a month later, but they're probably going to follow through with what we've priced in. That, again, is not as attractive to trade. Now, why would I rather trade this outcome than either one of these two outcomes is purely based on positioning, right? With the markets already this short on the Canadian dollar, if we do get this type of outcome, that's probably something that I would look to trade anyway. Aussie CAD short looks attractive there with a lower risk, like I said, because it's not going to be a clear, clean-cut hawkish. There's the risk of reversal, right? So dollar CAD shorts could be on the table there. I still like the Aussie lower for the reasons that I've explained a lot in the last few weeks. So Aussie CAD shorts on the back of a hold, but with guidance towards cuts. That could be an option, but it's going to be a lower risk trade. It's not going to be as high of a conviction trade. The other one that we could consider on the back of that, again, dollar CAD short on a big ISM miss, right? So we're going to probably see dollar CAD push lower on a hold decision from the bank anyway. And then if we see the ISM data coming in super, super low, we could potentially just look for an extension to the downside in the dollar CAD. Those are the options for a hawkish with a risk of reversal. The base case scenario for today, in my opinion, the one that I would have the most conviction in trading, would be a clear, clean-cut hawkish decision. That means holding rates steady, and guidance states that the bank needs to see more evidence of inflation falling and remains data-dependent, no clear guidance towards cuts. That'll be the clearest outcome we can hope for. If we get a whole decision with them coming out saying, listen, we need more evidence. What we've seen, we are moving in the right direction, but we need more evidence. That will give the markets doubt, not just obviously to price, they will have to price out the cuts that's already priced in, but what it also requires them to start contemplating whether we are going to get 65 basis points worth of cuts this year. If they have that type of data dependence view at this stage, then we might not see 65 basis points worth of cuts. So that, in my opinion, would be the clearest way to trade today, again, considering positioning. There's a lot to be unwound if they take that type of view today. And what we can look to trade there, very clear. Again, I would look at the exact same trades like this one, Aussie CAD shorts, but this one not with lower risk. I'll trade that with my normal size risk. And in terms of dollar CAD, again, if we're going to see dollar CAD push lower anyway, and if the ISM then comes in with a pretty bad number, we can again just, you know, kind of chase that move lower in the dollar CAD. Key levels I'll be aiming for here for this. 136 is obviously a key zone. Below that we've got the 135.70, and below that we've got 135.50 coming in. To the upside, again, we've spoken about those key levels to the upside there. In terms of Aussie CAD, levels to aim for, 90.60, first key level of support. Below that we've got that 90.10 coming in. Two very clear levels to aim for to the downside. So that is the levels what we'll be aiming for. Those are the outcomes that we'll be looking to potentially trade. But like I said, this one is going to be messy, guys, and we need to be careful with it. The last thing that you want to do is, you know, take a trade just because you see the markets react initially. Yes, these things can create some very juicy volatility, and if you get in at the right time for the right reasons, it can create some pretty fantastic results, but we need to know where the risks are. And in a decision like this, I think there's more risks for messy outcomes than there is clear outcomes. So just keep that in mind as we approach the BoC.